My name's Cornell Clayton. I'm the director of the Thomas S. Foley Institute, and on behalf of the Institute, I want to welcome you out to our event today. Just by way of an announcement, we have two events next week, too, that you can put on your calendars if you're inclined to. On Tuesday at noon, we'll have a debate on gun control. That will feature Dan Byrne, who's a Seattle-based representative from the Brady Handgun Control campaign, and Robin Ball, who represents the National Rifle Association. So that should be a fun event. And then on Thursday next week at noon, we will have Tony Lockett, who is from a visitor from the European Union Commission, and he will be talking about political polarization in Europe. Now, today we are very honored to have with us one of the leading political scientists in the country, Professor Howard Rosenthal. He's a professor of politics at New York University and the Roger William Strauss Professor of Social Sciences Emeritus at Princeton University. His research interests include the application of formal theory and quantitative methods to political analysis. He has written on spatial voting, coalition formation, the role of agendas in shaping political outcomes, political participation, French politics, American political history, and the macroeconomic sources of divided government, political intervention in credit markets, and many other subjects in American and comparative politics. Professor Rosenthal has been a fellow of the Center for Advanced Study, the John Simon Guggenheim Memorial Foundation, the Russell Sage Foundation, and the Hoover Institution. He was awarded the Duncan Black Award for Public Choice from the Public Choice Society and the CQ Press Award, and is a fellow of the American Academy of Arts and Sciences. His most recent book, which is forthcoming with the University of or Princeton University Press, is entitled Political Bubbles, Financial Crises, and the Failure of American Democracy. Join me now in welcoming Howard Rosenthal.
Thank you, Cornell. It's very nice to be here. This is the cover of the book, and I really like the cover, so I hope you can judge a book by its cover. And in May, you should be able to buy this from Amazon or whatever. The basic question asked in the book was the crisis of 2008, one of democracy or capitalism or both? And the bottom answer here is that Washington destroyed America's financial security and failed to fix it. Although most of you look like you're too young to have ever had a mortgage, so but you will have to worry about the future. So a big part of the story is that the country was pervaded by the ideology of free market capitalism for a couple decades before this crisis, and the idea that markets could be completely deregulated and the participants in the markets would self-correct them. And this is a cover of Time magazine from, I believe, 1990, I can't really read that, in which the three of the real culprits of the financial crisis, Alan Greenspan, Larry Summers, and Robert Rubin, Rubin was Treasury Secretary, Summers succeeded him, and Greenspan, of course, was head of the Fed, were termed the Committee to Save the World, and they were also termed the Three Marketeers. And there are a couple sidebar stories up in the right-hand corner of the cover. One is about the Clintons, and the other one is about who wrote Shakespeare, which is probably the only question from here that will remain in another 500 years. Now this state of free market ideology was kind of enshrined in 1999 when the Glass-Steagall Act was repealed. The Glass-Steagall Act, again, since many of you probably, or even I am post-Glass-Steagall, but what was passed in 1933, and it separated commercial and investment banking. Okay. And it was repealed by the Graham-Leach-Bliley Act in November of 1999, and Phil Graham stated, "We have learned that government is not the answer," which was the spirit of the times. Graham, you may recall, was dishonored in the 2008 election campaign. He was serving as an advisor to Senator McCain, and he stated there was nothing wrong with what was happening in the crisis, that the United States was just a nation of whiners. And after that remark, he had to dissociate himself from the campaign. But what is kind of curious about our politics is how fast people are able to rehabilitate themselves. And in June 2012, Graham was able to write an op-ed piece with Glenn Hubbard, who had been an advisor to George W. Bush and is now the dean of the business school at Columbia. It's titled "What a Romney Recovery Might Look Like." There we were. In 2000, Graham was fundamental to passing the Commodity Futures Modernization Act of 2000, which basically deregulated the market for derivatives, which was the big part of the financial crisis. This picture appears in black and white in the book, actually. By September of 2008, Lehman Brothers failed on September 15th. These guys were not so happy, and this is Ben Bernanke and President Bush and Hank Paulson and Christopher Cox, the head of the SEC, not looking so happy. These are all official White House photographs. Now, Washington failing to fix it, who does Obama get to fix it? You get what I call the ancien regime. And in this photo, there's Gene Sperling, Peter Orszag, who now works for Citigroup, which is where Bob Rubin went to work, Tim Geithner, and Larry Summers, all participants in the Clinton administration, all Clinton figures. Instead of bringing in new people who might have broken up the banks or done whatever, okay? And sort of advocates for more radical change, such as Elizabeth Warren, were actually not well treated by the White House. And so this is the only photograph I could find of Elizabeth Warren on the White House website, which only shows them from the back. And Tim Geithner is doing something I'm not allowed to do as an academic. He's putting his hand on her. So that's the Obama administration's enthusiasm for Elizabeth Warren and more fundamental change. By the way, I'm very used to being interrupted, so questions at any time. If you get too disruptive, I'll shut you up. Okay. So government action in a financial crisis, the book that goes over can be split into two parts. One are what we call the bubble part, which is government not only fails to prevent bubbles, but abets them, and POPs, that failed government response to burst in bubbles. By the way, there's nothing particularly new about what happened in the financial crisis. You could go through and tell the same story about the savings and loan crisis that happened in the 1980s. It's just that that was an event that was about a $500 million event and not a $1 trillion event, but it was the same story. And a lot of the genesis of the financial crisis in 2008 was that the reforms that came out of the of the savings and loan crisis, which was in a piece of legislation called FEREA that was passed in 1989, were very weak reforms. One of the things that happened in FEREA was that they created the Office of Thrift Supervision, which was this weak regulator that became the regulator of AIG and some of the other bad guys. So nothing new. It's just a standard story of how the system works. So on the economic side, we talk about beliefs and institutions and self-interest as driving a bubble. There are lots of books by economists about the bubble, that many of whom don't discuss politics. And one of the better ones is by Carmen Reinhart and Ken Rogoff. and they point to the fact that you will believe that, this latest bubble this time is different. Bubbles never happened in the past. We will get our way out of it. We're better and we're smarter, and so what me worry? Let me just review for you the timeline that happened. So the vertical axis of this chart is the difference between the LIBOR, which is an interest rate that banks charge each other, that we now know is actually subject to price fixing. Scandals go on, and what's called the OIS, and it's basically you can just think of this as a measure of how risky banks think it is to lend to each other, and usually this spread is only about 10 basis points at a tenth of an interest percent. And then as people start to worry about the value of mortgage-backed securities, this spikes up and is still at a reasonably low level. And then you have the bailout of Bear Stearns, which probably signaled a lot to the administration about how the politics would play out when Jim Bunning, the senator from Kentucky, who knew more about baseball than about finance, after Bear Stearns was bailed out, Bunning said, "I thought I woke up in France." And then you had Indy Mac failing, you had Fannie Mae and Freddie Mac being placed into conservatorship. They're basically nationalized, but we don't use that word in the United States. That's one of our taboos. Free market capitalism is still alive. And AIG and Lehman Brothers failed. Washington Mutual failed. Wachovia failed. EESA that you see there is, you might better know it as TARP. That was the bailout legislation. And that actually fails to calm credit markets until the Treasury did a couple other things called the Capital Purchase Program and the Treasury Loan Guarantee Program, which basically said everybody is too big to fail. And then eventually, by early 2009, the spread had returned to normal. Okay. Now, what role did deregulation play? There's academic debate on this, but let me just show you two charts that come from some friends of mine at the Dallas Fed. And the horizontal axis is just time, and the vertical axis show the billions of dollars issued in two kinds of instruments. One is non-prime residential mortgage-backed securities. That's the blue line. And the red line is commercial mortgage-backed securities, which is the red line. And these instruments, which were basically pools of mortgages, were used modestly in the 90s. And then after 2000, the Commodities Future Modernization Act was passed, and both of these things really take off until the market crashed. The signal to the market was when the Banque Nationale de Paris hedge funds unloaded their portfolio, and both of these markets completely collapsed and had barely restarted by 2010. So this is financial innovation that was permitted by deregulation. Okay, basically, deregulation, its consequence was said that Wall Street could invent any product it wanted and market it. Okay, and this is a similar chart. One shows that for interest rate and currency swaps, which were currency swaps are a way for people to hedge themselves against changes in exchange rates, say between the yen and the dollar, or to hedge themselves against changes in interest rates. This market goes up and it stays up. But the credit default swaps, which were ways for people to insure themselves against defaults on these mortgage-backed securities and derivatives of mortgage-backed securities, zoom up and then crash. Okay. Now, there are beliefs, and there's also something about interest, and I decided to put this slide forward. It's not something that I can scientifically demonstrate to you, but I think a lot of the problem with markets not self-correcting is that we Americans are fundamentally dishonest people. We are a nation of cheaters. But I can say that, but politicians can't say it. So what do politicians say? So Barack Obama, a year after the crisis, goes to Pittsburgh to the G20 meeting, and he says, never again should we let the schemes of a reckless few put the world's financial system and our people's well-being at risk. Okay? Now that's not very original. We had the dot-com bubble and all that stuff happen in 2001. And what did President Bush tell us? The vast majority of business people are living by the rules. Yes, you believe that. And so a few bad actors can tarnish our entire free enterprise. And if they're bad, we'll put them in jail. Actually, Bush did put people in jail, which is more than Obama has done. Okay. And there's nothing new about Bush's remarks. So there was a panic in 2007, and Theodore Roosevelt said dishonest dealing and speculative enterprise are merely the occasional incidents of our real prosperity. There was only one president that got this right, but he didn't say it in public, but Arthur Schlesinger quoted him. Oh, yeah, well, I have to go backwards now. My father taught me that all businessmen were sons of bitches. Okay. Okay. Then he had to sort of actually do a public retraction of this one. So yeah, we live in the greatest country, as Sarah Palin has told us, and we can't face the reality that we're human beings like the rest of the planet. So political bubbles, we talk a lot in the book about the three I's, repose on ideology, beliefs, institutions, and interests. I'm going to talk today mostly about ideology and institutions and how they combine through polarization of our political system to affect things. So their beliefs are the same as economic actors. They think it'll continue forever. But the difference is that political ideology is not as flexible as economic beliefs. Okay? So free market ideology actually not only has persisted, but has become more fundamental since the form of the Tea Party, since the financial crisis. And I'm just not going to bother. This is the Oxford Dictionary definition of ideology. And then Ben Bernanke, when he was trying to get TARP passed, made this famous statement, there are no atheists in foxholes and no ideologues in financial crises. But in fact, he found there were lots of ideologues in financial crises, and he had great difficulty getting TARP passed. Okay? So, and there are distinguished economists who unfortunately got their own fingers dirty in the financial crisis. Joe Stiglitz wrote a shill for Fannie Mae that said there was only 1 in 500,000 chance that Fannie Mae, Joe Stiglitz and Peter Orszag and John Orszag would go bust. But Joe believes that ideology was what drove the financial crisis. Okay, and here's an interesting exchange in congressional testimony between Alan Greenspan and Henry Waxman. And Greenspan says he made a mistake in assuming that self-interest would protect everybody. And Waxman says, you found your view of the world, your ideology was not right, it's not working. And Greenspan said, yeah, precisely, because this has been working for me for 40 years, okay? The problem that the reason it worked for 40 years and stopped working was Greenspan didn't understand the problems induced by all the financial innovation that had occurred, okay? It was working because Glass-Steagall was working. Okay. And then there's another ideology that we talk about, which is egalitarianism, which is an ideology that came from the left. And you sort of had the perfect storm here, where the egalitarianism of the left combined with this idea of the ownership society that Bush got from Margaret Thatcher, right? And so they saw subprime mortgage lending, especially to racial and ethnic minorities, was an effective off-budget tool for redistributing income and wealth, okay? If we want the poor to have housing, we could just appropriate the funds. But that's a totally different problem. So Fannie Mae's portfolio of subprime loans grew a lot, and the private sector even more so, okay? But here's an expression of this egalitarian ideology that I found. I just happened to come across the 2003 annual report of Fannie Mae. And this report features an entire page, a full-color photograph of Angelo Mazzillo of Countrywide, who was one of the real culprits of the subprime crisis. And they quote Mazzillo as saying, everybody wins if we can increase minority home ownership. So together, we're taking on the challenge of getting more people into homes. And then Fannie Mae says on the opposite page, as Mazzillo notes, you can't quantify the emotional impact of home ownership so long as there is a gap in minority and non-minority home ownership rates. Fannie Mae and Countrywide will continue to make sure all Americans have the chance to realize the dream of home ownership. So this is a very strong endorsement of equality of results at a time when basically the politics of the country are going away from equality of results, affirmative action and various other things. This is just really striking. And these policies absolutely failed, okay? So this is a graph of home ownership rates in the United States from 1994 to 2012. And, they kind of went up continuously until, maybe I can see this better here, until around 2005, 2006. And then they continued to fall. But if you look at the graph closely, you'll notice that who did they really fall for African Americans? They were the ones that took predominantly the brunt of these foreclosures, okay? So it didn't fail, okay? Now, so, the ownership society, the other view is, if I got this right, is that you would own your home, and then, we don't need Social Security. That was one of Bush's idea. We would just all invest in our own retirement. We would own equities. So, what if you followed the idea, and you were just what is called a buy and hold investor? So, so this shows how you would have fared investing in financial stocks from on the right from 1999 up to the end of 2011, and on the left from 1989. Okay, the reason we chose 1999 is that's when Goldman Sachs was the last investment bank to go public, to dissolve their partnership. Okay. So the 1999 returns, just briefly, for everyone except Wells Fargo, are horrendous. Okay, and they're not much better if you take the longer perspective. So in the financial crisis, people that long-term holders of common stock in these firms did very poorly. So where did the money go? It went to the bonuses, to the executives, to the builders, to everybody else. And then, of course, Mr. Mozilla had some problems with fraud. He didn't really have big problems because when he sold Countrywide to Bank of America, they agreed to pay all his funds, most of them. Okay. Fannie and Freddie. So why were Fannie and Freddie private firms? At one time, Fannie Mae had the 5th highest market cap of any company in the country. Well, they were actually, Freddie Mae was created a little bit later. Fannie Mae was actually in the public sector, and it was spun off into the private sector in 1968. And this was just purely an accounting trick of Lyndon Baines Johnson. Okay? So if it is a public firm, the debt of Fannie Mae would have been part of the national debt, and he was running against the debt ceiling. So he privatized it to get rid of the debt. Okay? But that's not a great reason to do things. Okay? And then, of course, it became pressured to do more lending to low-income families. It started to buy back subprime mortgages from the private sector, and it failed. So Fannie and Freddie were not part of the current slide. If you had owned their stock, you would have nothing either. Okay, and what are the linkages? Here we see the revolving door. So, and we see all these people have been to Harvard and other elite institutions, which is another one of my complaints, but I'll shut up. Who was the CEO of Fannie Mae during the height of their bad activity? It was Franklin Raines, who had been director of OMB under Clinton. He walked away from Fannie Mae with about $30 million largely in pension. One of my policy recommendations is that all of your pension funds are protected from civil suits by law. So you can go out and run somebody over with your car this afternoon, and they will not be able to attack your pension. My recommendation is that you get $5 million worth of your pension protected, and the rest you can go after. Okay, and then his predecessor was a guy named Jim Johnson, who was Mondale's campaign manager. He was head of the Vice Presidential Selection Committee for Kerry, and he had a similar role with Obama until he got one of these Friends of Angelo loans from Mozilla, from Countrywide, and he had to resign. And when there's like a bunch of very prestigious government officials that got these loans, including Chris Dodd, who, because of this, could not run for re-election to the Senate, but then had the chutzpah to rewrite the Dodd-Frank bill. Okay. So one problem with preventing financial crises in the future is getting rid of this kind of revolving door kind of thing. And then the third ideology that we discussed, I see I'm sort of running behind, is populism, so I'll just boot that. So I want to talk about ideology in Congress, and we use something called ideal point estimates, which is basically we attempt to measure how liberal or conservative each senator and representative is. We find that these positions are very consistent across time. So I know Maria Cantwell is a liberal now. She's going to be a liberal 10 years from now. And I also know, if I know her position on financial reform, I also know her position on Iraq, on abortion, and whatever issue you want. These things are relatively well correlated. And I won't talk about the technique. Okay. So I should say that you actually should know this, because this is right off of clipped out of the New York Times, and this was something they published when Ted Kennedy died, and they wanted to make the point. Richard said I could use my cursor. Okay, that the Congress had become more polarized, so that the this shows the distribution of liberal conservative preferences in 1965 in the left histogram, and 2007-9 in the right one, and they wanted to show how much Congress had changed during Kennedy's service. And the darker bars are Democrats, the lighter gray bars are Republicans. And you can see in the 60s, there was a lot of overlap between the parties. The gray bars and the black bars are mixed together, whereas now they're just completely separated. And that's what we mean by polarization. Since the New York Times didn't attempt to explain where these things came from to its readership, I'm not going to try to attempt to explain where they came from today. Okay. So, and here's some measure of polarization. This is Mike Wallace interviewing Dick Cheney, and Cheney said, "Yeah, he was a nice guy, but we didn't have anything to talk about." We don't know exactly where polarization comes from. We have some concerns that it's generated by increasing levels of economic inequality. They track each other fairly well. It inhibits and delays policy responses, and it's largely been the consequence of movement to the right by Republicans. This is a very old cartoon claiming that most of the moderate voters are largely moderate. They walk up the Capitol steps and they meet moderate congressmen leaving, of which the most recent example is Olympia Snowe. Okay. So this model where we separate people into liberals and conservatives, the lines up at the top show the percentage of roll call votes, individual roll call decisions that are classified. This is now over 90% in both the House and the Senate. And it's not because there's a lot of unanimity in the House and the Senate. In fact, the lower set of lines shows that the average majority in the House and the Senate has been declining in time. So we have smaller majorities, less consensus, and more polarization. And one indication of the polarization is a difference in party means. So, in the last Gilded Age, at the end of the 19th century, there was a lot of ideological polarization. Income inequality was fairly high, and immigration was high. And then throughout the first two-thirds or so of the 20th century, particularly after the 30s, inequality fell, immigration fell after the 20s, polarization fell, and now polarization has rocketed and just seems to be, well, it's now at an all-time high, and I don't know what will happen in the future, but it doesn't look good. Now, how does this this graph compares polarization in the House to the relative wage in finance, from a paper by Thomas Philippon and Ariel Reshef, and they actually, this is the average wage, relative wage in finance says how much people in finance are earning relative to people in other occupations. They match up fairly well. Polarization leads the wage gap. Low regulation leads to high wage gap. Okay, what do they mean by deregulation? So bank branching restrictions were removed at one time. Glass-Steagall was legislated in 1933, which increased regulation. Interest rate ceilings, interest rates, there used to be regulated interest rates. They were repealed in the 80s. And separation of banks and insurance companies. They construct this index of regulation. And now the black line is their index of financial deregulation. The red line is the relative wage in finance. So in these deregulated markets, people in finance have done well, and so people from elite universities go to Wall Street rather than doing useful things. Okay, so I'm going to show you some pre-roll call votes that show polarization on financial policy. The first vote I'm going to show you is House passage of the Sarbanes-Oxley bill, known as SOX, which was the response to the dot-com bubble and the accounting scandals, Enron, WorldCom. And so this is the vote on passage. And so here we have, again, a histogram of liberal conservative positions. So the gray bars on the right are Republicans, and on the dark bars on the left are Democrats. And then there's something called the cutting line, and sort of on the left-hand side of the graph, that separates people that were predicted to vote against the Sarbanes-Oxley bill and people that were predicted to vote for it. Okay? And the Sarbanes-Oxley bill divided the Democratic Party. There were some liberal Democrats that didn't think Sarbanes-Oxley had gone far enough, and they voted against the bill, and moderate Democrats went along with Republicans who generally supported it. The little white bars that you see are people that are prediction errors for this ideological model. So, and there are two rather exceptional ones here. Those two white bars at the end of the Republicans are Jeff Flake and Ron Paul, which gives you some idea of what it means to get a very conservative score from our scoring of roll calls. Okay, and Jeff Flake, who is now the new senator from Arizona, some indication of further polarization. So this looks like both ends against the middle voting. Okay, Jeff Flake and Ron Paul voted against Sarbanes-Oxley because they were opposed to any additional form of regulation. Okay, of financial regulation. Okay, this actually is very rare. Okay, it's not just two guys that do this here, and it almost never happens. Okay, most things are votes that split Democrats or Republicans, and where the ideological model makes mistakes are people that are fairly close to this cutting line. Okay, so they aren't serious mistakes. Here's another vote that took place in 2007 before we were aware of the crisis. This was a bill by Representative Brad Miller from North Carolina to restrict predatory lending. The Miller bill is now largely incorporated in Dodd-Frank. It's part of Dodd-Frank, essentially. This bill is supported by all the Democrats, but now it splits the Republican Party internally, with Republican moderates voting in favor and conservatives voting against, and there's no both ends against the middle voting on this particular bill. Okay, so voting on these financial regulatory matters fits in to general liberal conservative voting. Here's a vote, again, before people think there's a real crisis, in July of 2008 to pass the Foreclosure Prevention Act. This was a bill that really didn't do anything for people that were being foreclosed, but had some symbolic things. The reason that everything the federal government has done in foreclosure has been a very minimal effectiveness is that none of it has ever been mandatory on the banks. Okay? And the incentives the banks have been given have never been given enough to get them to stop foreclosing. Okay? And it's also a pretty ideological vote. And what is this going to tell us? Okay, so why are there a fair number of errors by Republicans here? So there's a very interesting paper in the American Economic Review by Mian, Sufi, and Trebi, in which they are able to get geocoded data on foreclosure rates. And what they find is that Republicans that had high foreclosure rates in their district were more inclined to vote for this. They were going to vote, they were cross-pressured, and they voted against their ideology. Okay? And they were particularly likely to vote for the bill if the parts of their congressional districts that were foreclosed had large numbers of Republican voters. didn't state that too cleanly. Okay. So, so yeah, things that are happening in constituencies do cause some deviation from these things. So, on the auto bailout legislation, whether you had an automobile factory was important, if it was a domestic manufacturer. But they're a little different, and and Democrats had some variation in foreclosure rates anyway, but that didn't really influence what they were going to do. So before the crisis, voting on financial legislation occurred in a framework of polarized liberal conservative ideology. And what was the general political setting that shaped the response to the crisis? Again, I'm going pretty slowly, so I'll just accelerate here. The main point of this thing is this is divided into 20-year blocks, starting with Roosevelt, and basically the country shifted from being solidly Democratic to having a strong Republican presence. So it made any change happening. Okay. So now, but you can see ideological voting on finance going back to the enactment of the Federal Reserve Act in 1913. One of the themes of the book is that legislation frequently is delayed in responding to a crisis because it only happens after a transition in power. So nothing really happened after the panic of 1907 until the Democrats got control in 1912 when the Federal Reserve Act was passed, and Republicans didn't like the Federal Reserve then, and some Republicans don't like the Federal Reserve now. Okay. The manager of the Federal Reserve Act was Quarterglass of Virginia, who was in the House at the time, and he was also the guy behind Glass-Steagall. Okay, so ideology, in fact, was not changed by the crisis. People didn't learn anything. And what we did was, so these D's and R's are individual members. What is this, the House and the Senate? Looks like the Senate. Before, and we scaled ideology before September 15th and after September 15th, before and after Lehman, and the answers are basically the same. The points are on the line. On the line, one of the most deviant points is that of Russ Feingold, who was out of character and he voted against Dodd-Frank. And he's got oddball. So what happens after Dodd-Frank? So one of the ways in which response was needed a transition in power is that most European countries enacted a stimulus package well before the U.S., but nothing was done because we were having elections and we had this. The House passes this bill with Republicans and some moderate Democrats against. Ideology does extremely well. There's not much room for constituency interests or campaign contributions, except to the extent that they correlate with ideology. Some moderate Democrats in the House could vote against the stimulus package because they were in marginal districts, and their votes weren't pivotal. Their votes weren't needed. Okay. The Senate passes this bill with exactly 60 votes, including all Democrats and the three most moderate Republicans. Here's where our institutions matter, because there's a filibuster in the Senate. It's a perfect ideological roll call. The three moderate Republicans, they were the most moderate Republicans, okay? Potentially perfect. And so what's working here from what we have in political science? Ideology works, agenda control works, that is, the administration is crafting a bill that is just good enough to get the 60 votes, okay? And this is going through what is called the pivotal politics model, which is developed by Keith Crable from Stanford, okay? So who is powerful here at this time is Olympia Snowe of Maine. The administration wanted $900 billion. It only turned out to be $700 billion because Olympia Snowe said, I'm not voting for this unless you cut out $200 billion for state and local government employees. And that was the bill. Okay? So this is the House agreeing to the conference report on the stimulus package. It's almost a perfect spatial roll call. Here's the Senate. There's just this one mistake, which is Voinovich. And those three gray bars right next to the black bars, that's Olympia Snowe and Susan Collins and Arlen Specter. Yes?
How did you get the numbers on the x-axis? Like you got minus 10 to 10?
It's -1 to +1.
Okay.
And these are just, this is just a scale, and you could multiply the numbers and add a constant to them, right?
This is for a given Congress person.
This is the, yeah, the histogram, this is, so I was told not to stop away from here and point at the thing, so it's, let me see. I don't want to, okay. So right here, this tells us that there are about 10 individuals that have a score between 0.4 and 0.5, okay?
So you have some mechanism to score.
Yeah, and we score them based on the score comes from not how they vote on this vote or even all financial votes, but on their entire voting record during their entire service in Congress. So typically their score comes from about 1,000 different voting decisions per member, okay? Yeah, okay. Thank you. Okay. This one. So now we go to Dodd-Frank, June 2010. In the House, it's a replay of the stimulus. You know, they get the vote of Scott Brown. They need more people. It's a little different now. Ted Kennedy has died. The details are in the book. And Scott Brown gets the bank tax taken out, and this is the House vote. Some Democrats can vote against it because they're not pivotal. And and this is Mike Castle of Delaware, who would have been the second-ranking member of the House Financial Services Committee if he had not decided to run for the Senate. And part of the Democrats being able to maintain control of the Senate after 2010 was that he lost the primary to the witch in Delaware. Okay. This is the Senate vote, and it's also pretty clean. And that's Russ Feingold. Okay. And so what was Russ Feingold's impact on the bill? So there was in the bill there was going to be a tax on financial transactions to be paid by the banks. Scott Brown represents Massachusetts, where there's Fidelity Investments and State Street Bank. They didn't like this tax. And Scott Brown says, I'm not voting for this bill if the tax is in there, so the tax came out. If Feingold had voted for the bill, Brown's vote wouldn't have been necessary, and you would have had a bank tax. Just recall quickly that voting before Lehman was ideological. Here's another vote. This was a Democratic proposal to allow bankruptcy judges to pass foreclosure. This didn't come close to passing. Liberal Democrats liked it. Okay. Actually, they had the problem was here's institutions matter. It was cloture that failed. Okay. And this is the Foreclosure Prevention Act that we looked at. Now, I've overran what I was supposed to, my time, so I'm kind of going to close down with TARP. Okay. So what about TARP? TARP does not follow this ideological model of voting. It's not liberal conservative. Remember what happened was that they went to Congress, they asked them to pass this bill. It was rejected. And 10 minutes after it was rejected, the Dow Jones Industrial Average had fallen by 800 points. So 10 days later it passed with some changes. Okay. So why was it failing? So who was the agenda setter? Well, it was really the Secretary of the Treasury, Henry Paulson, because Bush couldn't do anything. He was at 20% in the polls. Okay. And Republicans were asked not to be ideologues. Okay. but the president had no persuasive power, right? They were asked to vote for a bailout bill, which was totally against their ideology. Okay? The Democrats didn't want to provide cover for Republicans, and they disliked transfers to Wall Street. In fact, the Democrats were completely rolled with TARP because Paulson had told them that the money would be used to buy back mortgages to keep people in their homes, and then he just used the money to give money to the banks. Okay? So they were completely rolled. And everybody was afraid that if they, and this is, the electorate not being too aware of what to do in the crisis, of re-election fears. Okay? So here you see the House vote on TARP, and it's basically just a mess. I mean, there are lots of there's lots of mistakes. Okay, and this is the second vote on TARP. It's pretty much the same deal. So what kind of explains voting on TARP? So the horizontal axis again here is ideology, and the vertical axis is the sort of an estimated probability that you would vote for the bill. And so there are the top line over there are on the right are safe Republicans. So if this is no, I guess just the top line is Republicans that were retiring. So they weren't facing re-election, and if they were moderate, they were very likely to vote for TARP, and they became less likely to vote for it as they became conservative. The middle line is Republicans in safe seats, and the bottom line is Republicans in vulnerable seats. Okay, so electoral vulnerability impacted this. The same thing is true for the Democrats. Except there's no curve for retiring Democrats because in 2008 no Democrat wanted to retire. They knew this was bad news for the Republicans that year. And the other thing you'll notice about the curve, for example, is there are no Democrats at the left who are in vulnerable seats and no Republicans at the right who are in vulnerable seats. So most of these people that are extreme liberals or extreme conservatives basically are in districts that are just going to elect them without any problem. Okay. So the next thing I was going to talk about was the crisis and the election of 2008, but I was told that I should have stopped to ask for questions 10 minutes ago, so I will stop.
We got about 10, 15 minutes for questions.
Okay. Yes.
Yeah, you talked about the political and economic alliance. Well, of course, President Eisenhower talked about the military-industrial alliance, and it seems to me you have the same revolving door there. And would you like to draw any comparisons?
Oh, yeah. Well, of course, the interesting point about what Eisenhower said was that the original wording was the military-industrial congressional complex. And the word congressional was deleted out of for political considerations. And I would call this the regulatory financial congressional complex. I think it's exactly analogous. There's the difference between what happened in this crisis and the savings and loan crisis in what happens with most other forms of government spending that we could be critical of is these other forms, such as defense spending, are on budget. So, yeah, we're getting ripped off year after year after year. Our agricultural subsidies, can I say this out here in Western Washington? Year after year after year, but we know it's happening. there's no surprise. Whereas when we have one of these financial crises and we have to have a bailout, then all of a sudden we have to come up with new money. And I think that's the distinction. Hi.
Well, it's kind of a different topic, but the question, current question of the national debt and conflict between Democrats and Republicans maybe is more like a black hole than a bubble. But would you comment on what you think policy should be and will be in the current situation?
Oh. Well, I'm not going to talk to you as an economist, but so of course the recession produced by the financial crisis is a major contributor to the debt crisis. Okay, and I think polarization is impeding our ability to deal with it. I think on the one hand, the Republican reluctance to do anything on the revenue side is bad policy. And I think the Democrats' reluctance to do anything about entitlements is bad policy. And instead of educating our young, we're indebting ourselves so that, my 96-year-old mother might live another 2 or 3 years. And I want my 96-year-old mother to live another 2 or 3 years or whatever. Maybe she can break 100. But as a policymaker, so here's my policy proposal, outrageous policy proposal. You get Medicare until you're 90, and then you're on your own. You get Medicare until you're 90, and then you're on your own, okay? It's actually a really decent proposal. It's fair. If you listen to Paul Krugman, who says that all these entitlement programs actually benefit the well-to-do because they live longer, so there you go, okay? And it would save an enormous amount of money, okay? Okay, something else I would do, okay? This tells you about the distortions, okay? We have national health care as long as your illness is kidney failure. The government pays for dialysis no matter what age you are. But if you have a coronary problem, they don't. So why doesn't Paul Ryan say, let's get rid of dialysis treatment for people under 65? Okay? This is just, we can talk about reform and by making it more efficient, but every industrial society is facing this demographic problem of people living too long. And I remember in the 70s, Kenneth Arrow, the famous Nobel Prize winning, I was visiting at Stanford that year. He came and gave a talk just to political science. He had been doing some work for President Carter on health care. And he said, what if we do these things and it's going to extend life expectancy and make everybody better off? And I said, what do you mean? This is going to be a financial disaster. And he just didn't get it. But that's where we are. So and the Democrats are just third rails that they're unwilling to touch. Okay? And what again happens, which makes it worse, which is just like we attacked housing policy by creating a subprime mortgage market and doing it off budget, we do these compromises like Bush's prescription drug plan and various aspects of the Affordable Health Care Act that make things more expensive than they need to be to buy off various interests, insurance companies, drug manufacturers, etc. So, yeah, I think it's, I could fix the problem fairly easily if I were the dictator, but
I wonder if you could, it's clear how ideological polarization makes it more difficult to address the fallout from a financial bubble. It's less clear if you can isolate the effects of of how ideological polarization may lead to financial bubbles? Or do you address that?
Well, I don't know that we address it successfully, but here is this thing that you had this shift to the right, this sort of view that the regulatory framework of the 30s was inappropriate, and you had deregulation in transportation. You had in the 80s, you had deregulation of electric utilities in the EPACT of 1992. And so there was this general view that markets were going to work, and it was kind of bought into. You remember the airline deregulation was really, all these things would go back to the Carter administration. A lot of the deregulation of interest rates, a lot of this stuff actually happened during the Carter administration.
There's all
But
bipartisan going on.
But then when the evidence started to accumulate that things were wrong, okay, that there was a lot of fraud in the subprime mortgage market, I think doing anything about it was made more difficult by polarization, okay? And so I just think that by the time we realized there was a problem in the markets, doing anything about it was, on the one hand, these guys didn't want to interfere with the people that were making money, or regulation was part of the ideology is that just regulation can never be right? So that's, and then the other aspect of doing the bailout, people in the Treasury knew that they would have to bail out the banks like in March of 2008. That will come out in the history, okay? They didn't do it because they knew they could not get it through Congress. So they needed the thing to be, to actually, the system to have actually collapsed to have addressed the problem. Okay? The same thing happened in the savings and loan crisis. I'm not really answering your question anymore. This was what happened. So sometimes it happened in the savings and loan crisis was that it would have required money, and before the 1988 elections, the Democrats controlled Congress and the Republicans controlled the White House, and there was sort of this bipartisan tacit agreement not to do any, even though everybody knew anything about it, because they thought it would make it more difficult for George H.W. Bush to be elected and Democrats to retain their seats. Yeah, but that's not a polarization story. Yeah.
Time for one more question.
No.
I thought one of the interesting things you pointed out was how there was responsibility for certain people who committed fraud during George W. Bush's administration. But then one of the things that stood out about this current financial crisis, there was a real lack of responsibility, at most levels. Nobody went to jail. Basically, we bailed out these different banks. Does ideological polarization identify how we deal with bad actors in financial markets?
I suspect a lot of differences, just people did different things and how easy it would be to prosecute them. That may be a part of the story. And, and another part of the story is that a lot of people that were prosecuted in the first crisis, they were executives of non-financial firms. Okay. So prosecuting them would not sort of cause a complete failure of the credit markets in this country. But, you know, HSBC was just fined $1 billion something, and this guy Breuer, who's the head of the criminal justice of the Justice Department until recently, was asked why there was no criminal prosecutions, and he said it was not our intention to cause the failure of a major financial institution. Which, you know, at least it was honest. So whereas if you cause the, you know, if Enron fails, it's just not as, well, Enron had actually failed anyway, right? But I think that's, you know, that's some of the difference. You know, I don't know. It's a good question. I don't have. And the other thing is, what I think adds something to my answer is if you actually look at what happened to accounting firms. So there were 5 big accounting firms, and Arthur Andersen was the one that was involved with Enron. And Arthur Andersen had some guys that were prosecuted, and they were forced into bankruptcy. As far as I can tell, what the other accounting firms were doing wasn't much better. But the idea is that if we had prosecuted all 5 of these firms, the accounting industry, you know, we would have had a major crisis in corporate accounting. So it wasn't done, and these accounting firms contributed to the financial crisis. They were still around. You know. So there you go. So there are a few big prosecutions under Bush, and that may have made us feel good. But whether there were fundamental differences or not is more difficult to say.
On that happy note, joining now, thank you, our guest.